Good morning, everybody. Just echoing all the welcomes that we've already had this morning. Fantastic opportunity for me to come across from the UK to just share with all you what it's like to go public in the UK. Just a quick introduction to myself. My name is Tim Grogan. I'm an audit and equity capital markets partner from the UK. I'll just move the slide on. It's got a bit of detail about me, which you may or may not be able to read. I spend the vast majority of my time working on IPO transactions, and the range of transactions that I work on can be very broad. So Judith mentioned the AIM market before. I do quite a lot of AIM transactions, but at the same time, so those will raise something like £50 million. But at the other end of the spectrum, I work on big, large, complex main market IPOs. The one that we've got up there is AO World, which on its debut in London was market capitalisation 2.7 billion. So there's a broad range of transactions, which in effect gives a good introduction in terms of the scale of companies that we can work with to support a UK listed in the UK. I will actually share the slides later because some of them do have a bit of detail on which those at the back won't be able to see. So I will share them and then happy to take questions after this. So first of all, I thought I'd put my presentation in the context of how Deloitte can help. And lots of people, when I go to meetings, talk about IPOs, and actually sometimes during the process say, Tim, what do you actually do? Which part of this circle are you doing? So one of the first things that's really worth understanding is the people that you'll be working with on an IPO. So I'll just pick out a couple of the key roles. So if we start at the top right, the independent advisor. This is an organisation, so somebody like a Rothschilds, who potentially will come in on a transaction and advise the shareholders on the actual transaction, because there is actually can be a conflict when we do an IPO, because the reality is that there is shareholders exiting the business who need their own specific advice, but then it's actually the company that is actually going through the process. So the independent advisor will typically come in and advise the shareholders. That role doesn't always happen on every single IPO, so I've never seen that on an AIM IPO, but on some of the big main market IPOs, we do see that quite often. The second role is the reporting accountant, and that's the piece that I want to spend the vast majority of this presentation talking about. So this is where you get a reporting accountant firm, so it can be your auditor, it typically is your auditor, and what we do is we support the business going through all the financial work streams. So as Martin said, those companies that like to market the business, we make sure that the due diligence supports the message that are going out into the market so that the directors are protected. The third one is the company lawyers. Delighted to have Denton's in the room, and I won't steal their thunder by talking too much about what they do because they're the experts, but the reality is any business that goes through the transaction will need its own set of lawyers to ensure that the prospectus as it's being drafted does give the directors adequate protection, and they're not actually saying things that they can't verify, and there's lots of other elements to the legal work streams. The next point is the sponsor. So any business that goes to the market needs a sponsor. If it's a main market, the role is called a sponsor. If it's going to the AIM market, it's a nominated advisor. And basically, these firms are your voice to the stock exchange. So whenever there's a query, whenever there's an issue or a problem in the process, the stock exchange will pick up the phone to the sponsor or the nomad. So really important role, and it's for them to support the business as you're going through the marketing process. They will also have the lawyers. I think I've done that the wrong way around, but yeah, there's a sponsor in the nomad, and then they'll have their own set of lawyers to make sure that they're comfortable with everything that they're signing off. Then clearly number 6, we've got the regulators. Humphrey mentioned that the UK markets are well regulated, and I completely agree with Humphrey. We're not over regulated, but it is a well regulated market. To actually get through a UK IPO from a process perspective is a lot more onerous than a US IPO, which can be quite interesting given the litigious nature of the US. You wouldn't expect that. I think the thing that we see on US IPOs is that the litigation and the challenges come after the IPO, where you have to go through Sarbanes-Oxley. And then quickly with the last couple of roles, so the banking syndicate, which is often led by the sponsor, they're the people who raise the money. You'll need financial PR. When you go public, clearly the clue is in the name, you are a public company, and anything that happens will be in the press, so you need a good PR company to manage that process. And then there's some final roles with the registrar and printers. Again, seems like an admin role, but it is a really important role in the process. And then finally, remuneration and tax advice, which I'll come on to talk to later. So, I set out all the different roles in the transaction. I always put this slide up just to show how complex it is. It's a bit like a jigsaw, really. And what I would say on here is the vast majority of the boxes that we've got up there are actually the financial work streams. So if we look at the bottom, legal DD process, UK eligibility, all of those things, if you expanded out what actually went into those areas, would probably be a similar slide. Clearly, I'm talking from a reporting accounting perspective, so I've expanded out all the work streams that I'm going to talk about. And one of the key things that this slide helps people understand is that if you took each one of those boxes, which represent a work stream, on their own, you would think that's pretty achievable. We as a business can actually manage that. When you put them all together and there's interdependencies between each element, and if one area slips, it has a knock-on impact on the next, it becomes a quite challenging process, and it becomes, like I say at the start, a jigsaw in terms of making sure everything fits in where it should be. So what we do is so what I've done there is it sets it out on a December year-end perspective, how we get the process through by the end of Q2. And the reason why the timing is important is the financial information that you put in your prospectus. If it's a main market listing, then you have to execute the IPO within 6 months of your latest balance sheet. So again, all of a sudden, okay, we can do that. If it's a big transaction for them on the main market, you would typically go and raise capital in the US. So it's not a US listing, but you would raise capital with US investors, and they would need additional comfort. To give that comfort, the balance sheet can only be 135 days old. So all of a sudden, the time to do this is shrinking and shrinking. So what we always say to our clients is, and it's just like anything, you should be spending as much time as possible in the preparation phase to make sure that when you push the button to do an IPO, you know you can get through the process, you know where the areas you need to focus are, and you plan it properly. It's like anything. We plan an audit properly. To use Humphrey's analogy, you plan a wedding properly as well. Although if we brought in-laws into the question, I'm not too sure how positive we'd all be about doing an IPO. Some key message from this slide is preparation is really important, because if you just think about the financial work streams and all the various moving parts, there's a lot to do. Add in the legal elements, the marketing, the investor piece, it becomes a quite cumbersome transaction. I'm not going to talk about individual work streams, because what I'll do is I'll cover that here. So there's 4 key elements to the reporting accountant role, and I'll just do a deeper dive into those areas, which are the HFI, which is the track record, long-form due diligence, financial position and prospects, working capital, and then right at the end, so that's probably about 85% of the work from a reporting accountant perspective. At the end, there's some other comfort letters, which are probably about 15% altogether, but when you get to that stage, you're in a pretty good place, and you know the transaction will happen. So if we start with the historical financial information, so for anyone who knows old money, that used to be called the short form report, and basically this is the 3-year track record of the business that is going to be subject to the IPO transaction. Now, most companies think that this is a straightforward piece of work, because you will have had your auditors audit those 3 years before, but it's actually a lot more complex than that, because when we sign off on the prospectus, the track record is subject to a fresh opinion under investment circular rules. It needs to be under IFRS, which not all private companies are there yet. So what that means is that it's a fresh opinion, which means a different team has to sign it off. So you can't just say, well, Deloitte have audited those last 3 years, that's fine. The company needs to prepare a separate document which starts at the profit and loss account and goes backwards 3 years, and then a separate team comes in and reviews the work so that the reporting accountant can actually sign that off. Now, there's a couple of nuances to think about in this situation. So first of all, we've already talked about the US 135-day rule, and we talked about the 6 months position where the information goes stale. Now, if you miss that window, it's absolutely not the end of the world, because it doesn't mean that you have to wait for the next year to do your IPO. What you can do is a stub period audit. So you can, instead of having 3 years, you could have 3.5 years, which again means that your IPO window is extended. But the problem with that is that it's another audit that you need to do. It's just something else to factor into the timetable and additional cost. There are lots of businesses that we IPO that have complex track records. So that means that when you show your 3-year history, you need to show that 3 years for 75% of the business. So say you've made a transformational acquisition in the current year, and that is the reason why you're going to do the IPO. You will, in your group accounts, only include that business from the date of acquisition. But clearly, if it's more than 25% of your group, that's fundamental for an investor to understand. So what you need to do in that situation is in effect have 2 track records, one of the group as it stands and one of the business that you've just acquired, which again is not insurmountable, but it's an additional work stream. You'd need to look at pre-acquisition information, and again, just another moving part. The other last piece on the track record are the accounting policies. So the accounting policies need to be, when you go public, need to be on the same basis as when you are public, and that also includes KPI data. So when you go out, so this is the bit where the boring audited stuff comes live, because when you go to market and you go and see the investors and do the analyst presentations, they will be heavily focused on your KPIs historically and then what the future looks like. You've got to be able to have that data that you're marketing the business on a historical basis, which then leads on to, do the sponsors believe that data? Are they comfortable with it? Which then leads on to the next point, which is the due diligence. So long-form due diligence in its simple form is financial due diligence. Anyone in the room been through a financial due diligence process? A couple of hands go up. I think I could speak for both of you to say it's a pretty horrendous process. It's very detailed. So imagine doing that due diligence process in the middle of a broader transaction. And basically what this due diligence is trying to do, it's trying to, in effect, provide a commentary to the track record that you put in the prospectus, so that the sponsor, any new non-executive directors coming on board can fully understand what business they're getting involved in. So all those KPIs that you've set out and you've put in your marketing presentation that you're talking to the investors about, the due diligence will, in effect, give you a view as to whether they are robust and supportable or not. So this is just a little message that if you are just marketing the business not on a whim, but without robust data, this is one of the areas that it will be picked up. So the next detailed area is FPP. So this is financial position and prospects. Basically, when you go to market, there is a listing rule that says that you've got to have adequate financial reporting procedures for a listed business. So in simple terms, if you ever needed to make a profits warning, could you do that? Have you got the information produced on a timely basis which is reliable that would allow you to do that? In the past, there was lots of companies that would have issues on profits. So when you go public, there is a range of profit expectations for the years that the brokers put out there in the research notes. If you are 10% outside of that range, it is incumbent on the directors to put a hand up and actually make a profits warning. In the past, lots of businesses would only ever put out profits warning after their audited accounts. So at December year end, they'd put a profits warning out in March, and the issue that caused the profits warning would have been in the previous September, and it was the auditors who spotted it. So you can imagine the litigation risk from the September of when the issue actually was to when the auditors spotted it. That's quite big risk. So this piece of work, in effect, gives the sponsor comfort and the stock exchange that you've got robust procedures so that, you know, at any point in time, you could actually make that profits warning. So the key granular work that we need to do in this situation is make sure that the management accounts are on the same basis as the accounts. So under IFRS, you've got the same KPIs that you're monitoring, and that you've actually got documented procedures for all the key areas. When I talk to businesses who are coming from an international perspective, and I echoed Judith's point earlier around, you know, 9 of the biggest IPOs last year were international ones, we are actually seeing bigger transactions, and they are coming from the international network. There's lots going on from all across Europe and across the globe that we're working on at the minute. The biggest challenge that I always see is corporate governance. So in the UK, we've got extremely high standards around composition of the board, you know, non-executives, having the right experience, the right diversity, providing the right challenge. That is something that the FPP work considers. So it's really important that you recruit the right board that can guide the company through the various challenges. Working capital and forecasting. This is, on an IPO, this can be a more straightforward process because on the big IPOs, a lot of the funds raised are underwritten, and the working capital exercise, in effect, is to support a statement that the directors make in the prospectus that says we have enough working capital for the next 12 months. So if the proceeds from the IPO are underwritten, i.e., you know, they are confirming you've got an underwriting agreement that's signed off, then you can take the proceeds from the issue into account into your forecasts. So you imagine most businesses that come to market are actually going the right way anyway. To then overlay significant funds, you shouldn't get an impact on the headroom. But this is still a big piece of work, and you know, the fourth report that we would look at. And then, I won't labour this too much. I said earlier that there's a handful of comfort letters that we issue on an IPO. And again, as you get to this stage, you're 85% of the way through. You know, you're all in the boardroom high-fiving because when you get to drafting these comfort letters, you are pretty much there. So we see it as, you know, when you get to this stage, right, we're pretty much there to go. I will just spend a bit of time on the bottom 2 boxes because these are big areas in themselves, but I'm by no way an expert in these areas, but I will just give you a couple of points to think about. So tax is important in everything, I think. It doesn't matter what you're doing, tax is always important. On an IPO, it's really interesting as well. So the tax team will get involved in the due diligence, the working capital, the track record, especially where there's been IFRS differences. But on a specific IPO basis, they'll become heavily involved if you've got different classes of share. So if you are IPOing in the UK, you can only have one class of shares. And we see lots of different businesses that have an interest in share structure, ABC schemes. They all need consolidated into one single class of shares, which can, you know, we can spend a lot of time looking at that because different shares will have different rights. And that will be a piece that the lawyers get involved in as well. The free float requirements are really important as well. So free float means how much shares are being traded in the open market and held in public hands. So for a main market, one would typically say you need about 75% of free float, and on AIM it's about 90%. Now the nuance here is, from an international perspective, is that if your topco, i.e. the entity that is actually subject to the IPO, is an international one and a non-UK one, then the 75% becomes a 50% rule. So again, that has an impact on the size of the offer. And I can see Tom's at the back as well, so Tom can answer some questions if there's any technical pieces on the detailed free float requirements, because there is an element of flexibility, provided you engage with the stock exchange at the right time. The other piece I would talk about is remuneration planning. So when you go public, that opens up a whole new host of incentivisation schemes for your people and the directors. what that will involve is closing out some of the old incentive schemes, not crystallising any losses or anything that you don't want to happen, but then creating new schemes that are fit for purpose in a PLC world. When you become a main market PLC, one of the rules for the accounts is that the remuneration report needs to be subject to a binding vote every 3 years. So what you have to do is you have to set out in your annual report what your pay strategy is for all employees, especially the directors. That's subject to a vote at the AGM, and then after that date you cannot pay someone outside of those parameters. So again, from that perspective, you need some advice, because things are never that easy, things are never that black and white. You need an element of flexibility in that pay strategy, which is why you would get some support. So that sounds pretty easy, doesn't it? Not. Which then just brings me on to IPO readiness, and I think when you sit through that, and we purposely do it in this order because, I mean, most people when they listen to me are like, when's he finishing? But I think when you go through that process, you kind of understand that there is a lot of stuff to do, and if you don't plan it properly, you're going to get yourself into something that becomes very expensive and might not get you to where you want to be. So as I said before, I'll share these slides. You don't need to see all this. But what we do is when we have a meeting with our clients, we put this slide in front of them and say, that's all the things that you need to do. So that, coupled with the original timetable slide, that's all the things that you need to do. Where's your team to do that? And more often than not, people don't have the right team set up. And you can argue around paying for extra people to work in the team, but the reality is you need a SWAT team of high caliber people to get you through the process, because you're going to have to get through all that. You know, we've all got to remember that the CFO and the CEO in reality won't be really getting involved in too much detail, because they'll need to carry on running the business to make sure the business is still doing that. But they'll also be out marketing the business. So it's really important that you've got good people doing the detailed work. As anyone who's ever worked with Deloitte knows, we like doing surveys to corroborate what we've said. And this survey pretty much highlights where most companies need to spend the time pre-IPO. So it's not surprising to talk about, you know, the first one being IPO strategy and equity story. Again, that's a really high, it's a high level piece, the strategy and the equity, but it comes into readiness and the detailed work that we do, is because you can have the best strategy in the world, but if we can't sign off on a due diligence report to support it, then it doesn't really mean anything. So that's a really important piece. I'd also pick out internal controls and reporting, which is the FPP piece, and I'd also pick out strength and team. That's really important things. Key lessons learned. Again, I will just pick out a couple of these. Strain on the finance team and resources. You know, what we always find is, and anyone who sits in a professional firm will know that we can throw resource at our projects, because, you know, delivering for our clients' deadlines is what we do. It's what we're in business to do. So we can always get the right people. But the worst feeling in the world is when you've got the right team and the client's not got the right team. And there's clearly independence constraints on us rolling our sleeves up. So having the right team internally at the company is really important. Need for single version of the truth, again, really important. In an IPO process, something will catch you out. If you make a statement in one area that can't be diligent somewhere else, it will get caught out. And finally, on that slide, at the bottom point, I don't want to scare too many people, but what we always talk about is this is a daunting project, but it is extremely doable. You've just got to plan it properly. Fees. I'll quickly go through what fees could be, because I know that's always a really interesting piece. So the banking syndicate would typically have a contingent fee based on the funds that they would raise. Some of them would also have a fixed fee. So that can be anything from 2% to 3.25. I have seen some 4% as well. But again, if you had the independent advisor, that role that I talked about at the start, they would help you negotiate down that fee. Independent advisor, sponsor nomad, again, it can range depending on transaction. These are just broad ranges, but 0.5 to 1 million. One of my clients, AO World, and you can Google this, the independent advisor had put a fee ratchet in that was linked to their enterprise value on float. So their fee ended up being £13 million, so which is clearly outside of the range, but it was a good deal at the time for them. Reported accountants, again, this is the bit that I do. And just looking, like I said before, these are ranges. One of the ones that I'm doing at the minute is actually exceeds the top end of that range, but I've also got a smaller aim one that is a bit lower than the bottom end. Hopefully I've got the fees right for the legal ones. Again, it's transaction by transaction, so we just always position us reporting accountants being a bit more than the lawyers. And then there's a broad range of other advisors and regulatory fees, but if that gives you a sense of, if you are thinking of doing an IPO and costs important, you're thinking about what it's going to cost you and whether it's worth starting, hopefully that's helpful. And again, it puts it into context of, do I really want to go into a process without planning it and commit myself to some of these fees? And then very briefly, life as a listed company, because once you get through the IPO transaction, that's not the end, it's in effect the beginning. And as anyone will have seen in the press, you are being constantly scrutinised. So, in the UK, good examples are Carillion, who have just been through a horrendous process, and that was played out in the press, partly because of the number of employees and linked to government contracts. But again, the PLC angle and the investor piece is always interesting. You're always reporting, so you've got 6 monthly reports to do. You've got year ends. The time frames for reporting accounts are shorter. There is an expectation that from the market that you will also do updates during the year. The glossy accounts, as we call them, the PLC annual report is just getting longer and longer. So I mentioned specifically the remuneration report. That used to be 3 pages, now it's at least 33 because of all the different parts that need to go in. There is a spotlight on financial controls. Again, examples like Carillion, etc., just bring it to light. The FCA in the UK are now fining companies for bad practices in that area. And again, the market is unforgiving. All you need is one blip and the share price can crash. So that was it for me. Hopefully it was interesting. Hopefully I didn't go on too long. I'm around later for questions. So that was it. Thank you.
Good morning, everyone, and a warm welcome again. Thank you so much to Her Excellency the Consulate General for hosting us in this absolutely wonderful room here, and to our partners, the British Chamber of Commerce and Deloitte, for making today happen. Great pleasure to be here. Now, I hope Tim hasn't put you off with all of the hard work that needs to be done to achieve a London listing. I'm here to hopefully give you a little bit of a flavour as to recent activity on the LSE, how we can help, how we structure ourselves, and some of the recent activity to hopefully give you a flavour of the levels of business that we're seeing at the moment. And I think it's a very exciting time to be here. The first point I'd just make briefly is that London's always been a hugely international exchange. When I first joined the LSE 5 years ago, the then chief executive caught me slightly unawares and said, "Well, Tom, you must know this. I'd been in the business, by the way, about a week. What's the longest listed business on the London Stock Exchange?" To which I slightly panicked and assumed it would be one of the venerable UK institutions like Lloyds Bank, for example. And that was the guess that I went for. Actually, it's Antofagasta, the Chilean mining business, that first listed 120 years ago for the purposes of rolling out railroads across Latin America. So the international nature of the financing of the LSE goes right the way to the heart of the DNA of the exchange. And to the point today, we have 2,300 companies on market. 35% of those are incorporated outside of the UK, and the activities of the businesses on there are represented in over 100 companies around 100 countries, around the globe. We also pride ourselves that it's a market where there is an entry point for companies of all shapes and sizes. I'm sure this will be picked up on the panel later on, but one of the things that I often hear from companies when I go around international regions is, maybe I'm a little bit small for the London Stock Exchange. And actually, what I would say is that have a look and keep in mind what we've done with the AIM market over many years. We've had the one global growth market that I think has sustainably worked. A number across Europe have opened and then closed in the last 20 years. AIM ploughs on. It's raised £100 billion for companies, for SMEs, in the last 20 years, and is still going strong. And the average capital raise for an AIM company last year was around the $40–50 million mark, compared to the 200 plus on the main market. So if you're a small growing business, there may well still be an entry point for London without feeling as if you're too small. We then have the main market up to the right. That was the focus of a lot of Tim's presentation and preparation, quite rightly. This is our flagship market. And thinking of the two Turkish businesses that listed on London last year, Global Ports and DP Eurasia, they both headed to the main market. Global Ports to the standard segment, DP Eurasia to the premium segment. And I'm sure the differences in those will again be picked up in the panel, so I won't labour that for the moment. I promised I won't spend too much time advertising, but I think this is just an interesting point to put the activities of the exchange into context of last year. We had 107 IPOs last year. We saw close to $20 billion raised in the IPO market, and a further double that raised in further issues for our companies. In fact, London saw more further issuance on our market from existing issuers than any other exchange globally last year. So there's huge liquidity in the market. And when you put that into the context of other markets, it just shows that it was considerably more than any other market. And from an IPO perspective, 4 times the proceeds raised on London than any of our competitors. These are a couple of the stats I've referred to. 107 IPOs last year. But what does that mean for you? I think the top right is interesting. 9 of the top 10 IPOs last year were international. I think, as we continue to have conversations with issuers, the B word, Brexit, is often a topic of conversation. Of course, understandably. But I think encouragingly, what issuers have come round to, once they've sort of looked through the noise, is what do I really want from a listing? I want to list in a market that's transparent, where the rules are clear, where there's good governance, where liquidity exists, where I'm close to investors, where I'm close to the ecosystem that will support my listing. Investor base, of course, but the research analysts, the sell-side community, the advisory partners who are going to support me. And that is as true today in London as it was pre-June 2016, and I'm very confident will continue. And issuers are clearly voting with their feet. Those 9 out of the largest 10 IPOs last year included issuers from the US, from Russia, from the Middle East, from Central Europe, from Ireland. So again, going to the diversity of our market. I talked about the geographical diversity of our issuer base. This is an important point that I think is often overlooked, that London's also a very international market for the investors that trade there. I think London's quite unique in the fact that only about half of the listed equity on our market is owned by UK institutions. So there's huge access into other institutions globally. 30% is owned by the US, just under 15% in Europe, 5% rest of the world. And by the way, that rest of the world piece is growing quite rapidly as capital pools continue to form in the Middle East, in Asia, China particularly. And in fact, one of our most exciting developments this year has been the formal announcement by the Chinese government that the London-Shanghai Stock Connect project is going to be up and running by the end of this year. The first structural link between London and China, allowing London-listed businesses to raise capital in China and vice versa. A very exciting development, showing that we're not resting on our laurels. Yes, it's an international market today, but we're looking to continue to spread the net and give our issuers the benefit of that global access. I mentioned the 2 deals last year, Global Ports and DP Eurasia, some shots of the management team taking a sigh of relief on the balcony when it was all over, and enjoying a well-earned glass of champagne shortly after that to celebrate the success. I think, as Tim rightly said, and I think it was very appropriate, his last slide was around life as a listed company. We're clearly very keen to reiterate that an IPO is only a point on a company's journey and really the start of a new chapter. And one of the things that we're here to do within the primary markets team of the LSE is to make sure that you are fully equipped with everything you need, not just to survive as a public company, but to thrive in that environment. I won't labour this. There'll be some hard copy presentations available around the coffee break, which has some of this data in. But again, just to highlight some of the diversity of transactions out of Southern Europe, mainstream Europe, that we've seen in recent months. Energean, for example, the Greek-managed oil and gas business that operates assets around the Eastern Mediterranean, as at this point has been the biggest IPO on the London market year to date. I mentioned AIM. Again, some interesting statistics here for those of you who are sitting within the SME world. If you are looking at growth markets as a way of raising equity capital from a listed environment, worth noting that over the last little while, the AIM market has been responsible for about 3/4 of all of the growth capital raised across Europe, and some of the other growth markets, second markets, are listed there. It really has been one of our success stories. And to the point I made at the start about, am I too small for London? Again, this should give you some comfort that there are some very small businesses on the AIM market that have successfully raised capital. One at the moment that will be pricing at the end of this week, we're raising £2 million on about a £10 million market cap. So these sort of size of transactions are very possible with the SME ecosystem that has been built up in London over many years. I know the topic of today is around going public and what can London offer, how do you do it, and of course that's rightly the main topic for today. But I would just highlight one programme that we have up and running called Elite, which we're very proud of. It was launched about 5 years ago in Italy. Italy being our sister market. It's the one other European exchange owned by the London group, where I think the challenge had been you have some fantastic family-owned, family-controlled businesses coming through who've never taken external capital, who don't necessarily know where to turn to for advice, and who get to a point where perhaps there's a generational shift in the business and they don't know where to go, and maybe they just sell the business because that's the easiest thing to do. And so the idea of Elite was to provide a framework for growing businesses to say, how can you keep growing? And how can we help guide you as to the different sources of capital available? Which may, by the way, be the public markets. It may well be other steps in the meantime, raising private equity finance, raising venture capital finance. So we have over 800 companies now in the programme across over 30 countries, and including 6 Turkish companies in that mix already. And through a partnership that was announced late last year with Turkonfed, we expect that number to grow as well. So for those of you who are thinking an IPO may be very interesting, but I'm 2 or 3 years away from thinking about it, do have a think about Elite, and there are some materials again over the coffee break that, or grab Axel or myself, and we can give you some further details. And again, I know this is not the topic for today, but one final point to say, it's not all about equity finance. Once you're there, you need access to all sorts of markets. And one of the things that we've spent a lot of time in the last 12 months focusing on is our debt market offerings, allowing companies, issuers of all types, be that sovereign, quasi-sovereigns, corporates, banks, to raise capital in the easiest way on our market. And again, for those of you thinking about debt financing, the London market has a very compelling offering, which I'd be happy to talk to you more about over a cup of coffee. So I think I've probably outstayed my 10 minutes already, but hopefully that's given you a bit of a flavour for recent activity. Really delighted to be here. It's an exciting time in Turkey. Huge number of very ambitious and entrepreneurial businesses. We've seen some of that last year. There are one or two already in the pipeline for the London market, which I won't refer to, but the press has done already, so I'm sure you can guess what I'm talking about for later this year. We're very excited to be a partner of choice internationally for exciting Turkish businesses, and look forward to seeing more of you over a coffee. Thank you.